Hello, thank you for joining us today. We're going to give you a brief update on the FASB's new standards for not-for-profit financial reporting. My name is Janice Snyder, and I'm a partner at McKonly Asbury, and I have with me Jim Schellenberger.
Hi, Jim Schellenberger, as Janice said, an audit principal with McKonly Asbury, and I spent my career working in the not-for-profit industry.
Great, thank you, Jim. We're here talking about these standards today because they're the most significant changes to not-for-profit financial reporting in over 20 years. These standards are effective for fiscal years beginning after December 15th, 2017, and for most of the nonprofits out there, that's your fiscal year ending June 30th, 2019. But before you tune out, you're going to have to think about this on July 1st, 2017, as you're going to need 2 years of comparative data. This standard addresses 5 major areas of changes, and these include net asset classifications. It includes presentation of functional expenses, investment returns, liquidity and availability of resources, and the cash flow statement. So Jim is going to start with the net asset classifications.
So one of the biggest changes to the financial reporting standards is the net asset area. And the FASB, in its goal of rewriting the standard and including some enhancements to it, has focused on disaggregation of net assets and enhanced disclosure. The idea is to make financial statements more comparable from one organization to the next. So gone are the days of having 3 types of net assets: unrestricted, permanently restricted, and temporarily restricted, and it's been replaced with 2 categories, those with and those without donor restrictions. There are now enhanced and now required disclosures regarding self-imposed limits on unrestricted net assets, those typically referred to as board designated, and there are also required disclosures regarding underwater endowment funds, previously included as permanently restricted. Those disclosures include things such as the board's policy for spending underwater endowment funds, the fair value of the underwater endowment funds, the original gift amount of those funds, as well as the interpretation of any relevant law and regulations surrounding those.
Great, thanks, Jim. I think the changes to 2 classifications of net assets will be very significant. But you also mentioned endowment funds. I think it's important to note if you're in Pennsylvania, you need to follow the common law requirements under the Pennsylvania Act for those disclosures, as Pennsylvania is the only state in the nation that has not adopted UPMIFA, which is the Uniform Prudent Management of Institutional Funds Act. So something to keep in mind as you consider Pennsylvania law. The next big change is investment returns. Investment returns previously had to be disclosed on the statement of net assets. However, you had to break them out in a footnote showing the net asset depreciation or appreciation, as well as other expenses that netted into that investment return and interest and dividends. Going forward, you need to make sure that you are netting all direct costs against that investment return, including salaries and other items and benefits of the individuals that work on that, with the appreciation, depreciation, and the interest and dividends on those investments all in one line. So certainly that will make it easier, but you need to make sure you're capturing all of those costs net on that investment return. Now I'll turn it over to Jim.
So the third area of major change is in the expense area. And there's a new requirement to report the expenses of a not-for-profit organization by both their natural classification and their functional classification. Previously, only certain types of entities, those classified as voluntary health and welfare organizations, were required to present both of these formats of expenses. Again, as I said before, the goal is to make financial statements more comparable from one organization to the other, but also allow the users of financial statements to better understand how an organization is using its resources and its expenses. This requirement to present both the natural and functional classification is required to be in one location within the financial statements. That can be either on the statement of activities, the notes to the financial statements, or in a separate statement. And you also have to now disclose the allocation methods used to determine the functional allocation methods.
I think those allocation methods and that disclosure could be a little bit of a challenge, as there are many different ways organizations can allocate those expenses.
Certainly agree with that.
Thanks, Jim. The next significant change is in regards to liquidity and availability of resources and the disclosures there. This requirement is for both qualitative and quantitative disclosures surrounding your availability of resources over the next year. So this is very significant because most organizations don't have to look forward a year and say, are they going to be liquid, and have that information and provide a detailed disclosure, both in terms of numbers, which discloses your cash available, the investments that could be sold, as well as other receivables and current assets that could be utilized to fund expenditures for the next year. It may also include available borrowings on your line of credit and things of that nature. And in terms of qualitative aspects, you have to describe a little bit about how those funds will be utilized and that you will have sufficient funds to meet those expenditures. So certainly something that will require a lot of dialogue between management and the auditors to make sure you get those disclosures appropriate.
So the last area that we wanted to highlight is the statement of cash flows. And the original exposure draft for the changes to the financial reporting standards included a requirement to require the use of a direct method for reporting operating cash flows. Well, I'm happy to report that that requirement is no longer required, and the not-for-profit organizations have the option to choose between using the indirect and direct methods. The FASB recognized that using the direct method will be an additional cost and amount of effort to report and comply with the standard, and that was not what the intention was there to have. The good news, additional good news, is that if you do choose to use the direct method reporting of operating cash flows, you do not need to include a reconciliation using the indirect as well. So it's a little bit of good news there as well.
Well, I know I'm pleased to hear that we're not going to have to use the direct method cash flow.
I think we can all say that as well.
Well, great. So 5 significant areas of change, including 2 classifications of net assets, investment returns, liquidity, availability of resources, disclosure of your expenses by nature and function, as well as the statement of cash flows, giving you some options there. So again, this is for June 30th, 2019 for most of the nonprofits, and we look forward to helping you implement this standard. Thank you.
Thank you.